Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. And I know you're going to get tremendous value from the gentleman we're interviewing today. His name's Steve Firestone, and he's with the Crown Bay Group. And Steve's been in the business a long time. He's owned as many as 1,850 doors at one time, and he's actively buying and selling right now. And just glad to have you on the show, my friend. Thank you for joining us.
Thank you for asking me. I'm really happy to be here.
Absolutely. So please, let's start like I usually start an episode with having you describe how you got started in real estate and really how you got to the incredible success that you enjoy today.
Well, real estate wise, just in general, goes back quite a ways to probably 1998. So I have been in real estate a long time. I didn't just, get into multifamily just, out of nowhere. Admittedly, but I started out just doing, I guess at that time, probably a little bit prior to fix and flip was a, catchphrase and things like that, doing just that. I fell into real estate by accident. I was buying, houses and condos and whatever you want to, things like that, fixing them up. And then that grew from there. And I actually, I wanted to get into development, so I was trying to figure out how to do that and to get into building. And I, as you do, after a couple of years, you run its course. You need to get to the next step. I met someone who was a mentor who turned out to be a very large development company, property development company, and sort of taught me all about commercial property. We were buying large sites, repurposing properties into apartments and loft flats. And
where was this? What city?
That was actually in the UK, in London.
Oh, wow. I was going to ask you if you were a Brit. I noticed the accent, and I didn't want to assume, but
yeah, that's always a big talking point because people go, "Where are you from?" And I always go, "New Jersey." And they're like, "No, you're not."
Yeah.
But, I am actually born and bred in New Jersey, and somehow I wound up there in my early 20s in London, as you do when you don't have any responsibilities, and it was just an accident.
I actually thought you were Brit.
Stayed for 20 years. No, I it's just like I said, 3 weeks turned into 20 years, and I really got involved in property while I lived there. Like I said, in real estate, and eventually after a couple of years met these guys who happen to be they're actually still a listed company in the UK, although hence retired. And my mentor was the man with the golden touch, sold off his shares before the market crash in his own company.
Wow.
But anyway, he really taught me value add right from the very beginning, and everything about all types of commercial property. And at that time, I was sort of thrown in the deep end, and they already had owned apartment complexes even over there. And we were right away, project managing, doing rehabs on those, leasing those, doing what we do here now. But also on top of that was, literally building from new, repurposing large buildings into, like I said, apartments, office buildings, retail properties. So I really had a real mixed background.
That's a great foundation.
3 years of everything. Yep. And then I went off on my own after that, and really was doing a lot of development. Just they actually backed me after they ran me ragged for 3 years. It took me for granted. So I was a good, fast learner. And I started building small developments of, everything from townhouses to, some retail, even some small commercial units, things like that. So, whatever we could find. Of course, the market's a lot smaller in the UK, as I like to remind people over there. I hope not offending any Brits there, but I'm afraid it's the facts that you guys are only the size of Florida. And,
oh, I'm going to get hate mail for that. Thank you for that.
But the fact is, it really is down to opportunities, and it is limited compared to what's.
Let me ask you a question, if I may, Steve. What is different? Because I do get, I have a lot of listeners in the UK, no question. What's different over there? We don't have to go down that path too far, but just at a high level, what are the differences between investing in multifamily there versus in the States?
Well, that's the thing. It's such a big difference there because the multifamily market, as we know it here, garden apartments and all that, in a way doesn't really exist there. It's really because the apartments, as we know, are really more government controlled. and owned, that is really what they call multifamily. Now, a lot of the apartments that are privately owned are on the smaller scale because there are a lot of, as we said, repurposed buildings. That's a really big thing there because, of course, there's a shortage of land. So a lot of repurposing buildings, everything from large old Victorian houses that you would maybe have 6 or 10 apartments in, to everything to an old disused pub that you would again build maybe 12 units in. So on the bigger scale, it was really more new development, and then private people buying what we would call condos, buying those units and then renting them out themselves. So
individual units. Okay.
Yeah,
And
really weird, totally different sort of market in a way.
Right. What's the financing like over there? Just that'll be the last question. I just was curious.
Yeah. Well, that's the other thing that was really tough there because especially at the time when I started, there is no Fannie and Freddie there.
Right.
So you're on your own. It's banks or banks.
Okay.
And
so banks then.
Yeah, banks, and you got to build a track record with them. Really, or they're not giving you a penny. And luckily, I had slowly built up a little bit and was able to get some development funding. And that
sounds like you did a lot.
Yeah,
so you came here to the States when?
I moved back here in about 2010.
Oh, perfect time.
We had the market crash in 2008. It was no different over there. It was like the day after Lehman Brothers crashed. It was like the next day I was on the phone to my bank, who I had just built this big track record with, going, "It's Steve. Steve who?
Yeah, right.
The guy that we." No, I don't know. Kind of.
Yeah,
it was like no one to sell anything to anymore. No one's lending money. Career over.
It was like a faucet turned off. I mean, it wasn't like it went to a slower and then dripped. No, it was just on and then it was off. It seemed like one day to the next. It was insane.
Really was. I really felt like, my career, which I loved what I do, was just like that, over. But it was also a forced break, which I'm a workaholic, and I kind of needed a break. And I don't say that I'm happy about the crash, but we didn't get hurt too bad. We had a few things that we owned that we had to sell off at small losses, but it also enabled me to have enough money to be able to live for a few years without having to work, which was a great thing. And that's what I took the time to move over here. My wife is actually from Sweden, and I met her in London, and she was already living there for a long time, worked in an investment bank, and we decided, okay, let's take this time. Let's, it took a year to get her a green card. We decided, we used to visit Florida all the time. My family lives there. So we decided, got to move back to the States, which I had wanted to do for a long time anyway, and get involved in real estate. So that was really our first, starting to think about.
So where in Florida did you move? And then what was your first deal here?
Oh, well, we moved to Boca Raton.
Okay, nice.
South Florida, near Fort Lauderdale, Miami. And I didn't really do anything for a couple of years because I wasn't sure what exactly I wanted to do. So I started to look into what was available to me here. Now, I didn't really have any contacts here for funding or anything like that yet. So it really was pounding the pavement, starting from scratch. So we had this idea for Crown Bay. We did flip a few houses, and we tried all those kind of things, and which was okay. It was a starting point, but it enabled me to meet more people. I did go to some these different education classes to find out more about different asset classes, and I already knew about multifamily, and I had already been looking at apartments even when I visited my parents in Florida over the years. So it was something I already knew about and wanted to get into. So I really just, sort of nose to the grindstone, focused on, multifamily. I thought that's the best asset class, and I still think it is the safest and the best. And just found out everything I could about it here, and how to do it properly here, and investment-wise, investors. Just all the ins and outs of it, what locations I picked out about, did a lot of research on, demographic research, picked out about maybe 4 major markets that I wanted to try to be in. So I started calling up brokers, as you do. And of course, if they don't know you, you don't have the track record, you've never done a deal with them. It's not easy, as I'm sure some of your listeners know, and will experience. But you just got to persevere.
Right.
And I did. So what I did was I luckily had the time off where I could do this. I traveled every few months. I'd go to the same places over and over again, meet the same brokers in every town, want to see every property they had so I could listen to them tell me about the properties. And, I really learned that way. And
Hey, let me stop you for 1 second. Guys, that's a clue. That's what's called a clue. Go visit multiple times, let them see you, develop those relationships. It's critical, especially when you're brand new. Otherwise, you haven't got a shot. They're not going to take you seriously. They need to know that you're really in this, and to give you a shot, especially in this hot market. Okay, please.
And even if you're going to do it, everybody, we all have to do a little bit of fake it till you make it kind of thing. But,
Right.
you still got to have something to back it up. And I think that, again, showing your face and that you mean business, you flew out there, you're meeting with all these people, especially once you do it more than once, calling on the phone and expecting to get a deal, not going to happen.
No, it's not going to happen. You develop those relationships over the phone first, then you go visit, you break bread with them, you let them see you and get to know you.
Yep.
Okay.
And that's the same thing I did with investors as well. I started to talk to everybody. I never really did necessarily, family and friends, but sort of, I guess the next step from that, and just started to, again, the same year, spend building that up, telling people.
So talk about how you did that. How did you find investors? Where did you go to look for them, and how did you develop those relationships?
Yeah, it was really difficult. I did talk to some friends and family, but I didn't feel comfortable actually doing it. Maybe like the next sort of one, step away. Like a friend of a friend. But
Right.
and I do have some friends now that are in my deals. But at the time, they didn't feel comfortable, and I didn't want to push it. So I really just did a lot of networking at every event I could go to that was multifamily or real estate based. Would go, the usual, join the local RIAs. Just kept talking, telling people what I was doing. Then they would introduce you to other people, and it just grew from there. And then I had my first deal, and I had some commitments from people. And unfortunately, my very first deal, which was that multifamily deal, was in Atlanta.
How big?
That was first one was 137 units.
Wow, that's a big first deal here. But of course, it wasn't your real first deal, but your first domestic deal. And so, where was that located?
It was the first multifamily. That was in Atlanta.
Atlanta.
First,
Okay.
Like real multifamily acquisition of Crown Bay Group.
Okay, I got you. Okay, so it wasn't your first. It was the first. Okay, got it.
I aside from flipping houses and things like
Right.
that, this was the first official deal of us, doing what we do. And I thought about it a long time, and I actually looked, especially being in South Florida, there's a lot of smaller properties on the market that are seem very appealing, from 20 units and 30 units, 40, 50, whatever. And so I started out during that year when I was going to other markets, looking at bigger properties. So I really knew I wanted to do 100 units plus. And I think that's really critical too. A lot of people tend to gravitate towards doing smaller properties because they think it's really just down to, financials. They just think, well, it's easier to borrow less money. But that's not really, and what I try to tell people when they ask me, is not the best reason. It's better sometimes to really wait longer and, start, if you really want to do this as a bigger business, so you're not just buying a couple of properties for yourself, to start with, as close to 100 units as you can get. And the real reason is it's having staff on site is a whole different thing. Having, even just one, 100 units, or even, 80, 90, 100, you can have one manager, one maintenance guy, but they're there every day. They're keeping an eye on your property. What's going on. You have eyes there. When you have less than that, and you have to rely on, first of all, you're paying more management fees, like you would be in more residential, where you're paying anywhere from, 6 to 10%. Because they're only managing 20 units for you, or 30 units. There is no one on site. There's no one in a leasing office there for them to go to. They're calling up phone numbers. Someone has to meet them there. You usually have, every time there's call outs, which, I'm sure your viewers know what that is on the properties. We have hundreds of call outs a month, of tenants that need things fixed. and we have our own on-site staff. Most of our properties, we have 3 people on staff in the office and 3 on site that are 200 units plus. But when you've got a 20, 30 unit property, you're paying for every time a management company calls out someone to go fix a toilet or whatever by the hour. And
sure. And maintenance can be a real profit center for a management company. You know, they'll hire some kid at $20 an hour and bill them out at 75. So
it just eats away at your bottom line.
Yeah.
So that was really the main thing, and just wanting to grow fast as well, economics of scaling, things like that. So
now you're unique. You're unique in the fact that you do low income property, and I'd like to dig into that a little bit because I don't think I've ever had anyone on the show actually that's their focus. So, for example, that 130 some unit, what was the per door cost on that? Do you recall?
I think at the time, we paid about maybe 30 a door for that one.
Yeah. See, okay. I mean, that's a number you don't even hear today, but that lends to the. So would you call it a C minus area, D area? What sort of?
I just came from there right before I just came on with you, because we have another property there. Actually, we just sold a property there last year, another one that we had owned. That we bought later on, and we just bought another one there, literally within a couple of blocks of each other. Wow. It's I guess you'd say it's just a C properties. C minus I think is pushing it. I don't really like to, there is a limit. I think even within the C class properties, what I call workforce housing. There are different levels, and we try to stay towards the upper part of that, or make them that way. Taking a C property, making it into a B property, things like that people always talk about. I think those are real exceptions. They're not really the norm. You can't just change a whole area. You can make your property. What we always try to do is we try to be the best property in our market.
Yeah, and that's a sound strategy I hear regularly is to be the best, be the best of what you're competing with. Now, let me ask you a question. Obviously, do you self-manage or do you use management company, third party?
We did, starting from when I just told you when we bought that first one, of course, right from the beginning, you had third-party management.
Right.
I had, again, at the same time during that first year of networking, interviewed various property management companies in different states. Mm-hmm. And I had met this one in Atlanta who I really liked the guy. He was very helpful over that first year of looking at properties with me, telling me what he thought before I bought them. And we went with them, and we worked with them for quite a while. And then about a year ago, we decided to open up our own management company.
Bring it in-house. Yeah, that's a very common transition. Okay. So let me ask you this. What is different, if you can help my listeners, about managing a low-income property? Obviously, it's much more management intensive. And so what sorts of things you're going to have more late fee income, you're going to have more turnover, you're going to have more damage when a unit turns over, but what are the sorts of things? What do you do to mitigate all of that? What are some of the things you do to mitigate all that?
Well, first of all, a lot of people, as you're saying, you haven't had a lot of people on with what I would call, low income or workforce housing. And the first thing I want to say is just to stick up for it for them is that a lot of people and investors also, now it's different. You get even the equity groups buying C properties, which wasn't even the case even 2 years ago. Mm-hmm. It was just starting, but now they realize there's a lot of money in there. Mm-hmm. That is the demographic that is not going to go away. These people are necessary to our economy. They run the country. We have the busiest airport in the world in Atlanta. A lot of our properties are within 5 miles of there. A lot of the people work there. They work in, everywhere from fast food, shopping malls, industrial sectors, manufacturing. Those people aren't going anywhere. I don't care what happens to the economy. These people run our country. And just because they rents happen to be expensive, or, even in a low-cost area, but you're in a city, it's expensive, they don't get paid as much as is necessary to live properly. Well, that's low income housing. So to me, these are hardworking people. Yeah, there's some that we have problems with, but the majority of them are just good, hardworking people.
They're hard workers. Yeah, and I don't disagree with you. It obviously, You're going to have more crime. You're going to have
Yeah,
these other things that I mentioned.
yeah.
So back to my question, how do you mitigate all that? How
Right.
do you mitigate and manage effectively so that you minimize as much of that as you can?
Sure. Well, the first thing is that we, when we're doing our underwriting, it might be a little bit different
Oh, sure it is.
from a private property because
Because
we
of the
are,
maintenance.
well, maintenance, and we are also counting in our underwriting and projections for a higher turnover,
Mhm.
for more, as you say, repair and maintenance after
Vacancy. Hmm.
vacancy, things like that. A lot of skips and evictions.
Hmm.
So that's all factored into our underwriting. So
Hmm.
if it doesn't work with all that in there, then of course it's not a good deal.
Right.
And then the other thing, really, as I said, a lot of people really actually don't. Even the big management companies, we've found over this time from taking over properties from a lot of people, that even the big companies, they do not know how to effectively
No,
manage
no,
these
I agree
properties.
completely. That's why I'm surprised that you hung with the third party as long as you did. But let me drill down. Do you mind drilling down a little bit deeper on
Sure.
what you just said? So let's talk about vacancy. Let's talk about repairs and maintenance per unit, and
Yeah.
and obviously flips and skips. Talk about, I mean, on a real granular level. Like, let's say you're analyzing a property. What sort of a vacancy factor would you put in your analysis?
Well, it depends on the property, but I really just use
Yeah.
like 10% as
10.
a,
Okay.
uh,
10's good. And then on repairs and maintenance per unit, all things being equal, I don't know, do you buy, what age properties do you typically find? Is there a, like a
most of our
average?
properties are 70s.
70s. Okay. So what's in a 70s property? What do you factor per unit per year for repair and maintenance?
Well, and that also depends really on the property, what's already been done to it.
Yeah.
We have to take into
Yeah.
account, what
Sure.
have they already spent on it, what heavy lifting items have already been done, whether it's
Right.
roofs, whatever it
No, I'm
is.
not talking about CapEx. I'm just
No,
talking
I
about
understand.
repairs and maintenance. Yeah.
Yeah, but of course, if someone's renovated units, it's
Right.
less.
Right. It's going to be less.
But
Sure.
I usually put about 600 a door in.
600. That's all. Wow. Okay.
Yeah,
That
six to
seven
seven
me.
hundred maybe. Yeah, it's
Okay.
not that bad because we don't really buy anything that's that bad. If we
Okay.
buy, we don't buy projects necessarily. What I try to, we do have some that are bigger renovation projects, but the majority, what I try to do is there's a sort of a fine line of what you can buy that is already cash flowing, but is just not being managed great, does have deferred maintenance, but you can still get away with just about passing it through on a institutional loan.
Right, right,
And
right.
that's what we
But
try to do. Find
the
that
reason
fine
that
line.
the reason that I'm surprised by that number is you're going to have more turnover, which is going to increase that repair and maintenance number. Or is that a different line item?
Well, not no, because we have repair and maintenance and turn costs. So it can be two separate line items, but at the
Right.
end of the day, if you're doing a quickie underwriting, it really just is the one line item.
Okay. All right. All right. Fair enough.
Might
Fair
bump
enough.
that up a little bit depending on the property, but uh, what because of what we do, we take them over. We do all the deferred maintenance, and we know what our plan is. Having a plan is the biggest thing. When you do your anybody who's going to obviously buy a property is going to do their due diligence. When we do our lease audit and our 100% unit walk during our due diligence period, that is our roadmap to figuring out what we're going to really spend there, because we
Mhm.
know right away what their turnover is existing already, so we can factor that in. We know what every unit looks like. We make a spreadsheet from the lease audit, from the unit walk. We know every unit on our spreadsheet. That's our roadmap. This one has and it only takes a few minutes for each unit to go into,
Right.
for
Right.
people that know what they're doing. And right away if the appliances are more than
Dated, the hot water heater, all these things that are, yeah,
it's all like sort of it's
flooring.
been replaced. It's over 10 years old. It's this, it's that, the flooring, whatever. So we take that away, and while we're still in our due diligence period, can work out really what's the real cost of what we're going to spend on per unit on turns and all that. And then the next thing is, of course, we always expect to on every property we take over, the first 2 quarters for the first 6 months is always the highest turnover
Sure. Sure.
and the highest turn cost, because they're existing people that you want to purge the property of all the
Right.
people.
You get rid of the bad eggs. Right.
Yeah, and there's usually a lot of them, because the management, once people getting away with things with management, it carries on. So if people weren't paying, they just think it's their right not to pay anymore.
Right.
So until there's a new sheriff in town.
Right.
So it's about a good 6 months to get rid of the first few waves of people and to set the new rules in motion. And then what we find, because of what we do in our model and from our experience, it starts to slow down after that. And that's when it starts to, we
stabilize
down, and then we start to come back up a bit by the end of the first year. So that second half of the year is the building back up. And we start to have less turnover. We're doing the vetting the way we want, so we have a lot less turnover. And
speak to that for a second. Speak to the vetting. Speak to what do you do differently there that you might not do on an A or B property?
I'm not sure what other people do, but I mean, we do. It is a full credit check. It's through our property management software. Goes through a credit agency. We do our
criminal.
Like criminal check is always. We don't do any no criminal background. We check for evictions.
FEDs.
If you have evictions, you're not. We don't even do that, even in low income properties. Bankruptcies.
You take do you take previous bankruptcies?
We'll take it into consideration. There's always that pile that we have on the side that come through that are
subjective.
And then those are the ones that our manager on site will then speak to the regional for those ones, and she'll judge whether we should give them a chance or not, and what they call second chance, and then we will adjust our deposit based on
right.
that.
Adjust the deposit
from only a couple of $100 if you're totally clean to a full month's rent if you're have had issues or your credit score is not quite there. So we are flexible a little bit, but not on criminal.
So what's your favorite tenant story? I've got some doozies, because by the way, my background is this same demographic. I didn't want them to hear it from me. I've had 2,000 houses that I've managed long term, multiple apartments as well. But it was all the class that you're in right now, and so I mean I could have answered every one of my own questions, but I wanted to hear your perspective. So what's your favorite tenant story? What's the craziest one?
Oh gosh, you put me on the spot now, because there's a lot of them. And unfortunately, a lot of them are criminal, and we do have the odd shootings and things like that.
Yeah. By the way, do you camera the whole property? Do you have cameras everywhere?
Yeah. I mean, one of the main thing that our model is we're doing workforce housing, but our whole model is based on it's clean, it's safe, and it's in good condition. And we give good service. That's it. Right. Call out service is most important.
Right.
And then crime is a big one. So we take over properties. And
by the way, guys, I'm sorry. Call out is maintenance requests. So if they've got something they want fixed, that's the Brits' way of calling it.
Yeah, if you keep people happy with fixing their stuff, they're okay. But crime is a big one, and I learned that really early on what to do. And we don't get fazed by that at all. And we've got better deals because we bought.
Sure.
We just bought one in Jonesboro in South Atlanta that is actually under contract now. We're selling it already in less than 2 years, and it was the Wild West, and we knew that. But it had great bones. It was a good property, deferred maintenance, but it really was gangs down there and all of that. And we do the same thing that I learned to do. We do it on every property. We right away we find out. We find out what's going on, where are the people coming from. We fix, obviously, the boundary fences.
Right. Perimeter fence is critical, right?
Perimeter fences.
By the way, do you know Maureen Miles?
I know Maureen very well.
Yeah, she's a very good friend. She's come and visited me here many times, and she's given me some funny stories too. But that perimeter fence thing is what she told me, is that whenever they have problems on a property, there's always holes in the perimeter fence. She told me.
And they never go away. They always come back somewhere else,
Right.
You fix one of it, but they get tired after a while sometimes. Sometimes not. But the thing with the cameras is most important. And a lot of landlords, even the big ones that have the money, they always spend their money on the wrong things, I find. This is even like institutional landlords. Camera system, it's like 10 grand. I mean, it's nothing. But better than the cameras themselves, it allows you to put signs all over the property.
Right.
So we always
smile. You're on camera. Right.
The second you drive into our property, we got your license plate.
Right.
And that's signed at the entrance. That's it.
I got to share a story just because it's so funny. Maureen told me a story that she was having trouble getting. It wasn't the tenants; it was the boyfriends of the tenants, and they knew they were dealing drugs. And so she put flyers on everybody's door that said they were going to volunteer. You probably heard this story too, I'm sure, but that they were going to volunteer these units to test the dogs for drug sniffing. And it was like cockroaches, man. Boom, they're gone.
Yeah, I heard that one.
Yeah, that's awesome. But you develop a good relation. You develop a good relationship with the police as well, right? I mean,
that's what I was just going to say. The other thing we do, the second we take over a property, we go to the local police, introduce ourselves. We're a proactive landlord, because although you'd think that they could just come on there and arrest people, in actuality, it's private property. So we're actually almost giving them a license to come and arrest people. So this one in Jonesboro that we bought, we met with them. Right away we sat down, and they have their own drug, department. Gang department. Right. And we made a plan. They said they were really happy that we wanted them on our property, and we did actually pay them. The police actually do work off hours, and it's totally allowed to do that. And we made a plan with them for their off-duty officers. Instead of having private security, which I think is worthless, we had them in for 2 months, and they already identified all the known drug dealers and people who had warrants. And they went in a first wave. In our first sort of 6 weeks, they arrested all those people. And then, of course, once you start the ball rolling, you get all the good tenants starting to tattletale and tell who's who. And it's just a big rolling effect. And then everybody starts scattering. And as I say, that once they know we mean business, there's police, there's cameras, there's evictions. And then, it takes about up to 6 months. Yeah. And they go find another property.
Sure. They find one that's not as diligent, and they move. Yeah.
Exactly. I've seen that. They're not going to change the area,
Right. I've actually seen, I was just going to say, I've actually seen that happen in an area. I saw that the police was so diligent on a few block area that I had it. They blocked off the street. The cops stayed there. And one thing that I did once was I actually allowed the police to have a desk in one of my units that they could come and sit and drink their coffee and whatever. And there was always a cop car parked there in front of that unit, which was a very visible unit for the complex.
Well, that's always a great help. And that's another thing, just to mention as a side note for people listening, what we try to do in all our properties is, I don't know if people have heard, there is the term courtesy officer, but there also courtesy officers can be actual real police. Sure. And we really go out of our way to try to get police to live on the property. So we're always offering which I'm sure a lot of people do, groups do, to the local police department, a discount on rent for anyone who wants to live on the property. And usually we do get at least one, if not two people.
And they drive their patrol car home, and they park it out.
That's the thing. They have to bring their patrol cars home. So people know they're there. And, it depends on the person, how much they want to get involved or not. But they do take it serious, because if you get a police officer with their family, they live on your property, they don't want any trouble. Their family lives there. Yeah. So they make it very clear that they're not going to stand for anything. So they are sort of on call, if you like, without being on call.
Yeah, great idea. Yeah, great idea.
That's how let
me ask you this: that do you have a favorite failure that happened to you? I call them seminars. I've had massive seminars. 2008 was a huge seminar for me. But do you have a favorite failure that set you up for future success? Or just a time that you really got your nose bloodied, really got your butt kicked?
Not since I started in this guise as multifamily specific company, but I think really the big thing was the crash in 2008. I was literally in shock, because I've never been through a real estate downturn. I thought I was invincible, even though I was a landlord. I was renting some apartments and houses, but I was also mostly buying and selling, and thought I was a wheeler dealer, buy, build on spec, sell. And that really hurt. I mean, I really thought my career was over.
Yeah, me too. Can we talk, man? I was under a rock hiding.
I was literally. I mean, I was in shock for months.
Yeah, me too.
What am I going to do now?
Yeah.
And so my real lesson was no more spec building. I really like this business of multifamily, especially here, and especially workforce housing. it's and giving people just what they need: good, clean, safe accommodation. You can't go wrong. You cannot beat it. These
No,
people
you can't. It's just like mobile home parks. It's another great asset class that will survive any downturn, as will your properties, because
and that's not to say it's easy. It's
right.
not an easy way out. It's just that it's safe. And I always say, even bankers that I talk to, that they don't understand when you go to corporate bank, for banking purposes, not necessarily lending on properties, that are supposed to be pro-business. Even they don't really understand what you do. So when you try to tell them, and you need help, they're supposed to be business friendly, but not in our business, because they see it as very risky. So all they think is, you make this much money, and you're telling me there's no risk. And I'm like, yes.
Hey, listen, the thing that people,
reward.
yeah, the thing that they don't realize is that you've got great cash flow, and pretty much a check will solve anything. Okay, really. And that's the thing. And that's what I used to tell my ex-wife, when things would happen. The great thing about real estate is that a check will fix just about any problem. So you don't have to, it's not business threatening. You've got insurance for the real catastrophic stuff. But let me shift gears for a minute, because I want to ask you a couple of questions. I have listeners that haven't done a multifamily deal yet. They've done some houses like you started, like I started. What advice would you give them about this business?
Well, one of the main things that I have told people before that want to get into it from, flipping houses and that sort of mentality, is that you really have to change your mentality a lot. We're not trying to, although we do upgrade units and there is some of that to it, of, making it look nice and decorating or whatever you want to call it. Sure. But it really is a different mindset. You're not trying to make a house look great to sell it to a family who's going to live there and own it. So you in this business, especially on this scale, every penny counts. When you're just doing one house at a time, first of all, you got to always find the next house. That's the next thing. That's one thing. And also, you're trying to make that on your budget as good as look as beautiful as you can. Well, and you can do that because you have a budget for that one unit. But for our properties, you got 200 units of whatever you're going to do to the property. Every single penny counts, on the bottom line. It makes a huge difference. So we don't look at it, we try to do the things that are the best bang for the buck. Obviously, repairs and maintenance is necessary, and preservation. But, if we're going to add things to the property, I've seen guys go broke from like buying a property that they thought they were going to up.
They over improve.
Yeah, 50 units in, they're done.
Right, because they over improve. They do things that aren't necessary.
Things that aren't going to change the rent that they can achieve.
Right. There's got to be a repayment on whatever they put in. You've got to calculate that. Now, let me ask you this: do you do any things to kind of stiffen up your properties to make them a little more battle proof so that your turnovers don't cost as much? Do you do the solid flooring? Do you do things like that? Any unique things to this particular asset class?
Yeah, we do obviously think about that. Improvements are partly what we think is going to look good and make the properties get the most rent, and partly what's going to be the most sustainable as far as damage and lasting and things like that.
Even if you pay a little more sometimes because of the longevity.
Absolutely, because that's where you start getting into those calculations of like, how long a life against how much you're paying, and you can get quite granular, as you know, on these things. But within reason, once you find out what does work, this is a very rinse and repeat business. So we have, we've got it down to where we know if we're going to say buy a property and upgrade half the units, it's basically an upgrade in a box, aside from the painter and the flooring company. We know what flooring we're going to have. The rest of it is just, we already have our, SKU numbers of our items, from everything from faucets to lighting package, whatever. And it literally, we say it comes in a box for that property. For that unit.
Yeah. That's how you're really effective.
But yeah, we try to get the best quality we can for the budget.
Yeah.
What's appropriate for the property.
Sure. Awesome. So let me ask you one last question. Knowing what you know now, what would you tell your 20-year-old self to do differently about this business?
Wow. That's a tough one. I mean, I think it's just a learning curve, no matter what, no matter where you are. But I really can't. You stumped me at the moment.
Did I? Okay. The most common answer I will tell you is people say I would have started earlier and gone bigger.
I was going to say that, but I purposely didn't say that because I thought that was a cop out.
No, that it's just I want my people to hear that.
Okay.
It's the same answer every single time. It's like start earlier and go bigger and just get started.
Exactly. I mean, I love what I do, and I love this business. I absolutely wish that I started earlier.
Well, there you go. There you go, guys. There you heard it again. It's the same theme every time.
But I do want to say one thing, if you don't mind.
No, of course not.
When we were talking about, saying that, because I don't want anybody to get the wrong impression that, it's just you just buy a property and it's totally risk-free, because that's not necessarily true.
No.
What there is a difference is, what I think people need to strive to be good at what they do is anybody can buy a multifamily property and not necessarily lose money. And this is where we talk about cash flow and of course the back end profits and adding value. When you're offering, 7 or 8% return to an investor from cash flow, plus obviously potentially profits on the back end and all that, that's great if you can do it. But the thing is, there's such a big, even 8% is a lot. If you go down to zero and make no profit, it would be very hard to lose money. So that was my point about being safe. To lose money on a property is difficult.
Right.
Right.
Well, that's what's so great. That's what's so great about multifamily, because there is that spread, and
you could just make no profits and make no distributions.
Right.
But
right.
They're not going to necessarily
But
lose.
the principal may not go away. But on that note, and I've talked about this recently. There are passive investors that are investing in deals with people that are too aggressive right now, frankly. I mean, they're doing deals they shouldn't be doing. They're overpaying. And if there's a hiccup, there could be a problem for these people. And so, and I tell my listeners, get educated. I don't care what your investment vehicle is, get educated.
Even if you're a passive investor, you need to have education. And
that's right. That's right. That's the point.
Know the track record of the sponsor, and that's the
point. That's exactly right.
Absolutely.
Well, thanks, brother. You added a ton of value today. It was a real treat to have you on the show, and this is some stuff we haven't talked about. So I'm really glad that we dug in to the workforce housing component, because that's definitely a profitable niche for the right mindset and the right personality, and I think you have to have a level of experience to go after that asset class as well. It's because it is a little more labor intensive and more management intensive, but definitely profitable and all else. But thanks for being on the show, my friend. Really appreciate you taking your valuable time to be here.
No, I'm really pleased to be here. I'm really thankful for you asking me, and I love sharing information with people, and knowledge is power. So anything I can do to help anybody, that's good karma all around. I'm happy.
That's right.
So thank you very much.
Thanks, buddy. Take care.
Thanks.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please take a minute to visit iTunes and leave your comments. For more resources or to connect with us further, please visit our website at rodkhleif.com. Tune in next week for our next show.